Okay, good afternoon, everybody. I'd like to welcome you all to the Gulf Intelligence Global Energy Outlook Forum. I'm delighted to be presenting our three panelists here to join us for this final, panel session of the Europe sessions. We've been to Asia and the Middle East so far this morning, and to take the pulse of the outlook for the year ahead, speaking to the top 50 energy market analysts from Shanghai and ending up in Caracas later this evening. I'm delighted to be joined by Ole Hansen, Head of Commodity Strategy at Saxo Bank, Mark Otswald, Chief Economist and Global Strategist at ADM Investor Services International, and Maliha Bengali, founder of MB Commodity Corner. Thanks so much, everyone, for joining us. And we'll be discussing for the next half an hour the question of what's at stake for energy markets this year if central bankers misread signals on the easing side of rates, as they did on the tightening side. And indeed, to answer the question whether they are misreading it or not, we'll get the viewpoint of our panelists here. So thanks, everybody, for joining us. Maliha, let me start with you. You know, that question obviously is referring to the fact that for a long time, the Fed and other central banks were saying, oh, inflation, what inflation? And then suddenly, for the last, almost 2 years, we've had a rise of 5% in interest rates, which is quite extreme in a short period of time. Would you agree now, looking forward, and it's with the signals that we're getting from the Fed and other central banks, that we're perhaps in for a more predictable period, and therefore, will the market have an easier time of reading those signals?
Thank you very much for having me on. Predictable, no, but you are absolutely right. I think the Fed has surprised the market immensely in December and November. We caught everybody by surprise. It's interesting because, all throughout 2023, we feel the Fed had a dual mandate: price stability and employment. There was a third category, liquidity and banking system, which I think not many spoke about and got us by surprise as well. It's very interesting what the Fed has been doing in the background. This entire year of raising interest rates and monetary tightening, the backdoor liquidity injections have been quite impressive. Every time we had a hiccup back in March, Silicon Valley Bank crisis, or the repo actions back in September, we saw that they injected reserves. And I think Yellen has been playing games with the Treasury yield curve. Let's not forget, we have a lot more Treasury issuance to come this year. The US has about $9 trillion in debt to be refinanced this year. So they're playing games along the bond market curve. But yes, they are definitely in a situation where liquidity is tight in the system. They need to let go of this QT, maybe do QE at some point, but inflation is still not in the 2% region. So they're playing a very delicate game between perhaps cutting a bit too soon to support the liquidity and the banking system and economic growth, but perhaps reigniting inflation. I think that's going to be the key backdrop for 2024. And I think the Feds are willing to let go of the inflation backdrop to keep the system afloat.
Okay, thanks, Maliha. Mark, would you agree that we're kind of almost, by the sounds of it, in a trickier position now? Having, we have seen inflation come down, but is that secure now, would you say? Or are central banks going to still be cautious and bide their time in sort of deciding on what to do as we go into this year?
I think central banks will definitely be cautious. They got it wrong on the way up in terms of inflation, and on the way down, they're going to be that much more cautious. They've also got a very tricky environment to deal with. The economic outlook, above all, the supply chain risks, I think, from the geopolitical side are very substantial. No, you don't cure that by interest rates, that's for sure. But nevertheless, they have to be cautious because they know that, both due to the geopolitical risks and indeed due to, I've got people in Brazil saying, why are people selling soybeans when we've got a crop failure? So there's food and energy risks to inflation. There are geopolitical risks. They are all where the mistake lies with the Fed and the ECB and the Bank of England, less so the Bank of England because there's a more entrenched structural inflation problem in the UK. They're all fixated on 2%. And I think markets, two things with markets. One, they're going to always overdo it. So markets misreading the Fed or the ECB or the BOE is probably a given. On the other hand, they should assume that basically the central banks are going to be very cautious on the way down. So I think what markets have priced in at the moment is too much. and that we are still in for a period of higher interest rates, which will adversely affect a lot of economies.
Okay, thanks, Mark. Oli, I mean, would you agree? And what is the sentiment of the energy markets at the moment in terms of the year ahead? I mean, one could argue that last year, with all these unknowns of rates and what was happening, and we're going to see a soft or a hard landing in America, oil prices were not really impacted a lot, given all that uncertainty. You know, they were being impacted by OPEC plus policy maybe now and then, but not by geopolitical risk or anything else. So how much attention are oil markets paying to the central bank, policy and what may happen this year?
I think they will be paying a lot of attention, not only because of the risk appetite ebb and flow that we're going to see from expectations moving up and down regarding the rate cuts. And I think Mark just touched it really well there, because basically, are we seeing a soft landing? Are we seeing a recession? No one knows. I mean, both camps have got their valid points for coming up with those forecasts, and that basically means that is volatility going to be elevated? Perhaps not so much in crude oil, but I think generally we will see high volatility this year. We normally tend to see that when rates start to come down, simply because the market continue to guess about the depths of the incoming rate cuts, and probably on a regular basis getting it wrong. So we come out of a year where crude oil actually ended up in a relatively tight range, and I would say that's probably courtesy of the supply cuts from OPEC, basically preventing the market from falling at a time where potentially could have fallen quite a bit further. And I think that policy will be maintained this year. And with that in mind, the market is looking at the start of this year as a bit of a range-bound market. This tug of war between supply and demand, where it's likely going to be keeping the market fairly locked, at least for now. And we all know the two risks that can unfold. Either the OPEC plus steps back from their commitment, or we have a major geopolitical event that could either send price sharply lower or sharply higher. But for now, it looks like the stability is there relatively, and part of that is most certainly courtesy of these production cuts.
Okay, thanks, Ole. I mean, Maliha, on that front of OPEC and how it maneuvers around the sort of macro predictions that we're seeing. Obviously, nobody knows what's going to happen. Predictions for growth in China, US, etc., all to come. But would OPEC be thinking, for example, that the interest rate moves that we've seen in the last year are going to now actually hit even more in the year ahead in terms of trickling through to corporates, to manufacturing, to the industrial base? And what do you think would be in their thinking there? And how far could they go in trying to sort of react to that?
In October, I think there was a big sort of shift in dynamics. We spoke about that during the conference in Dubai. Basically, OPEC and everybody was in the soft landing camp. They were actually quite stubborn in terms of how much they need to actually cut. The market was a lot tighter. And lo and behold, 3 months later, we saw demand from China was a lot weaker and prices actually moved down despite the OPEC cuts. So I think there's a lot of reshifting and thinking in terms of OPEC as that maybe they got it wrong. Maybe the demand is not as strong. We saw Saudi Arabia lower their OSP prices to Asia this week. So obviously, there's some sort of a reckoning in that front. I think they've done a very good job in actually taking all the excess out. So the market is very finely balanced right now. The key in the market is not supply, it's demand. The main thing is, will there be a recovery this year? Will China come back? What is China's being a lot more price conscious right now than it was all of the last few years. So these are some of the big things right now. Do we have a recovery? Do we have a soft landing? I think that's going to determine oil prices. OPEC has done its job for right now. If we do get a harsh recession, then yes, there might be a rude awakening. But the key lies within China right now in terms of what they can do.
Okay, Mark, I mean, on the China front, many are saying what will happen, but I mean, we already have forecasts on the growth for its economy in the next year or two from certain parties, obviously coming in a bit lower than 2023. And, I put this question earlier to another one of our panels. Has the market accepted now? China is no longer growing at 8%. It's proven that for the last year or two. Is that being factored into people's expectations and calculations?
I think people are expecting a weak China growth. I think there's two important factors to remind ourselves of. China will always be, in commodity terms, whether it's oil or agriculture or metals, an agile buyer, i.e. high prices means they will withdraw, low prices they will capitalize on. Can we expect China's oil demand to be at the same sort of pace as last year? I doubt it, because a lot of that was actually for export of refined products. And if the rest of the world isn't going to do it as well, then the demand for that refined product isn't going to be that high. So I'm more concerned about the fact that China is actually getting to what I would call a Draghi moment, i.e., will they do whatever it takes to actually get themselves out of this property sector malaise? Because there is contagion. We've seen Zhongji go down and declare itself bankrupt. How many more of those will be? What will they do? And, how does that play out in geopolitical terms? Because, yes, no one's expecting China to invade Taiwan this year, but the old adage of if all economic remedies fail, then the military option is always there, should not be forgotten. I'm not making a prediction of an invasion of Taiwan, but I think the more this play goes on, the bigger it is. And so China, I think, is absolutely critical. At the moment, I wouldn't be particularly optimistic about the growth outlook there.
Okay, thanks, Mark. Ole, I mean, what about Europe? We've seen it struggle, obviously, for various reasons the last year or two, but things seem to have stabilized in terms of where Europe's getting its energy from the Russian angle, and the economy. Inflation's come under control to an extent. So how, again, we saw very negative figures come out of Germany in the second half of last year. So what's the outlook there in terms of how ECB policy may impact business, industry, and again, the impact for energy demand?
Well, I think Europe will still be an overall drag on the global economy. As you say, we're not going to see a sharp turnaround anytime soon, but obviously rate cuts will have an impact. We just saw, I think one of the major UK builders came out with a better result or better forecast, simply saying that they are seeing increased demand as funding starts to come down. So there might be some pent-up demand in that space. We may even see that in the US as well, as funding rates start to come down, that we see some of the property sector being revitalized. But generally, we still I think we're still stuck here. The CO2 border tax, which is going to come into play from 2026, we're already seeing now how Chinese steel manufacturers are scrambling to go more green on that front, or perhaps being getting more of an insight into production inside Europe. And that reshoring of some of this production may obviously also add the process in terms of bringing growth back. But Germany remains the focus there, and with so many of their major industries still struggling, from chemicals to heavy machineries to automobile, then it will take time for us to get on the other side of this. So any pickup in demand or stabilization demand will have to be China, where, as Mark mentioned, which is doubtful at this point, and obviously whether we get a soft or a hard landing in the US.
Okay, Malia, I mean, in terms of ECB versus Fed, we've seen obviously the ECB follow the Fed slowly but surely a couple of months later. Are we possibly going to see not such a tight correlation going forward, given how both economies are doing, whether it's the US or EU, or will we necessarily? Because we did see some hesitancy, some a bit more hawkish stance, let's say, from the ECB towards the end of the year and into the new year. So do you expect we'll see more of the same, whatever the Fed does a couple months later, or could we see those two diverge to an extent?
I think initially we'll see a bit of divergence. The ECB has always been late to react to some of the things. They still have a lot more inflation pressures in EU right now. They've made quite a few points about how they might delay and cutting rates. I think right now it's interesting because the market is pricing about 6 or 7 rate cuts in the US. The Fed's talking about 3. The big alpha right now in the near term for us is slightly dollar bullish, because if the Fed sort of holds back or just pushes back in terms of saying the data is not there, the market's not prepared for that. But I think once the Fed does start to ease, the ECB a bit more on a 3 or 6 month lag, unless there's a big economic collapse, and obviously we'll see them follow suit. But the ECB just generally tends to be in the bag, but they do have a lot more inflation sort of being anchored down, and they want to make sure they don't actually cut rates too soon.
Okay, and Malia, just sticking with you, you mentioned earlier about the US, continuing its planning to continue to issue more debt, and how that may impact, obviously, liquidity. I mean, are there any concerns? I know it's just more of the same, but, again, has the market just sort of absorbed that as it's continuous? It's not going to,
Not
come
at
to
all.
a
In fact,
standstill?
right now we had the quarterly refunding announcement on the end of the month. I think it's on the 29th. Back in November, Yellen actually surprised the market massively by issuing a lot more bills in the front T-bill market as opposed to the back-end bond. We saw a massive bond market rally that actually took the S&P and NASDAQ higher. So it'll be very interesting as to see how she shifts her preference of issuing debt in the front or the belly or the back end of the curve. This may sound a bit technical, but it is really what's driving equity markets right now in terms of duration assets, technology names, commodities. So we have to keep an eye on that. End of the day, the US debt now has hit 34 trillion. We've just announced another 1.5 trillion of a debt deficit ceiling raise. There's no end in sight. At some point, the US is just spending to no end. And each dollar of growth, like we talk about Q4 GDP came in at 4.9%, but all the debt and the spending, the fiscal spending amounts to the same amount. So every dollar we are printing is what's going to the GDP growth. So when we see the economy is booming, how is that really boom coming about? So yes, I think this year treasury issuance will be a big game because the bond markets have rallied to 4% on the 10-year. To us, that's fair value because you assume 2.5% GDP growth, 2% inflation. That's pretty much fair value. It's not pricing in for any inflation uptake. So we see more value in the front of the curve. But then again, how they sort of issue this debt, I mean, it's not over. The bond market it's not done deal for right now, in our opinion.
Okay, thanks. I mean, Ole, just back to you. I wanted to come back to the point of the cost of money and how that might be impacting operators, whether it's shippers who are going long distances because of the rerouting of obviously energy trade, or whether it's sort of this M&A activity that we've seen in America with sort of more cash-rich companies coming in and production there. But again, what do you see that the higher rates, higher borrowing costs trickling into the industry in any sector in particular more than the other, and slowing things down?
I think so, yes, and there is always a delay when from the actual hiking of interest rates to when they start to have a real impact from a personal consumption basis. It's not until your mortgage is up for refinancing that you really start to feel the pinch. Obviously, you felt the pinch initially directly from the high inflation last year, but that's also a reason why the current outlook which looks fairly okay for the US. I agree with Malia that it's borrowed growth that they have created, and the industry will be feeling the pinch from when they get into the refunding rounds, which with their average debt, corporate debt, probably less than 3 years, it will start to play its part this year, and that's why also it will encourage the process of lower interest rates. And I think when that starts, we'll probably not see quarter point cuts. We'll see half point cuts. And we also have to remember we have a presidential election late this year. So if they want to cut rates this year, they will probably be front loaded. So maybe starting in June, 0.5% cut in the following two meetings. So we get 1.5% cut before the presidential election. That's at least what we're looking for, based on current assumption. And then if we do get a recession, then perhaps the cuts would be close to 2%. But it does have an impact. It has a delayed impact, and that negative impact on sharply high interest rates will only start really to be felt now. So the only consolation for industry is the fact that they may feel that they see light at the end of the tunnel because funding rates have started to come down already, and perhaps will come down even further in the near term.
Okay, thanks, Mark. Will that hit, I mean, any of the refiners in particular, or refinery business, if you like, from a products point of view, or does it not have such a, in terms of the cost of business, the cost of operations? Do we see more sensitivity in that sector of the energy market than the upstream, let's say, or no?
I think it may hit some of the smaller refiners. This is it is a big year for refinancing, and that applies worldwide. We're only really going to see the impact of higher interest rates there. In terms of the hydrocarbon market as a whole, it's already moved into what I would call a tobacco phase, where they realize that most people are fairly hostile to them. Their finances are in good shape, not in no small part helped by 2022. 2023 obviously wasn't so great, but their finances are in good shape. They're not going to be that much impacted, and I would imagine we'll still continue to see big oil M&A going on as they look to reduce their stranded risk assets. The refining side of the equation, in general, the smaller level, and this is going to be true of all businesses, all SMEs are going to be more vulnerable to higher rates. And it doesn't matter whether it's energy or anything else. There will be some impact, and that will have some demand. I still think the other thing which is going to be absolutely critical in the US is how the lengthening of the Inflation Reduction Act and the CHIPS Act, the Semiconductor Act, it goes through this year, because all that legislation is sunsetted to end this year. And if there is suddenly a lot of budgetary austerity going on, that could actually have a huge impact on the US economy, and is probably one of the bigger risks outside of the geopolitical, in national terms rather than geopolitical terms.
Okay, that's interesting. So that legislation is still to be, some of it's still to be put through in terms of passing. I mean, obviously we've seen a lot of money forked out already and a lot of investments being made, but that's certainly a point. And that's in conjunction with US production, conventional production, having hit record highs at the end of the year as well, which is a bit of a contradiction. We have our panel survey question up there. Will a switch from a year of monetary tightening to a year of monetary easing be bullish or bearish for oil prices? So bullish, bearish, no impact. Maliha, I'll go to you to answer that question yourself for us, just generally speaking. Sure. If we continue to see tightening there, will it actually start to impact prices? And I wanted to also ask you, please go ahead.
Right. We think it'll be bullish. There's two parts to that question. Most of last year, now, as our readers and clients know, we've been very bearish the oil price. And now we come to a point we think that I think OPEC Plus may have tightened a bit too much. And that's a big thing for us to say that. We think right now oil prices will be in a very tight range. And if you do see some sort of a federal, monetary stimulus, QE or cuts, for right or wrong reasons, we think that's going to over tighten the market. We could see a price spike. That actually may work really well for the OPEC Plus. We knew from history speaking, they're very late to bring the cuts back into the market, where they're very eager to cut. So we think it'll actually be bullish, not bearish. In the backdrop of that they do the cuts, if it's going to be a massive recession, yes, oil price can be weaker, but it'll be a lot less weaker than the other commodities for sure. So we think it'll be net bullish for the oil price.
Okay, and oil is still cheap, people say. Maliha, just to stay with you on the sort of question of managed money or fundamentals dictating, price direction. We've had a lot of liquidity, obviously, and the funds coming in and out of the market last year, and a lot of the movement in price being attributed to that, correlated obviously to the physical market. But again, OPEC Plus taking the view that it's the managed money and algorithms that are sort of controlling things. Would you agree that that's what we're going to continue to see this year? Will there be any change in the dynamics on the ground?
Well, managed money is very important. In fact, I don't think that that's what altering the market. OPEC has actually caused a lot of volatility in itself from their decisions. The managed money just follows what OPEC does, either on the way up or on the way down. I think that's one thing we all need to understand. As of right now, there's very little interest in oil right now. The spec positions are all-time lows. Managed money is sort of very ignorant about oil price. They're completely apathetic, which gives you a good backdrop to take a look on the long side if you do see a price spike, because nobody's involved in it. So yes, we think spec money will be a big game this year as well, as it always does. And I think commodities as a whole will be very interesting in 2024. If our theory is correct, we see a sort of reignition of inflation, commodities will have a very good year. But timing is very important. Demand is key. But I think we'll see a good sort of trend there.
Ode, what about products? I mean, any outlook for sort of product prices? We had so in the Asia session earlier today, a bullish figure for jet fuel demand in China. Again, domestic travel expected to be very strong by the summer. But again, in terms of the cracks between various products, is there any expectation there on how those might fare? Of course, all depending on industrial and consumer activity, but from a cost point of view, from a central bank interest rate policy point of view.
Well, last year was quite to a certain point a little bit extreme, especially at the beginning of the year when we had this the reopening, which triggered a lot of widening of some of the spreads. Especially diesel and jet fuel was quite expensive at some point. Refining capacity is still coming back. We're seeing it shift away from from a place like the US to the Middle East and to Asia. China's refinery capacity is obviously very, very large at this point. So, and if their own domestic consumption potentially peak out this year, then there will be enough for that will support the global market. So I'm not really forcing any stress. We have adjusted to the Russia situation. That cannot really upset the market any further at this point in time. The supply route disruptions may have an impact, but generally, I see the margins staying relatively calm this year on that assumption, simply that the capacity is ample to cope, especially in a year where demand is going to be probably not as strong as we saw last year. Over time, it will be interesting how the market deals with the slow reduction in gasoline demand as EVs are rolled out in greater numbers. Because obviously that leaves a lot of gasoline, perhaps, which has got no consumer, while we still need to produce all the other products. So that's an interesting one but not for this year. That's going to be in the coming years.
Okay, thanks, Ole. Mark, just to go back to China a little bit. I mean, on the inflation question, of course, that's one country and big economy that hasn't had, the same struggle, let's say, with inflation as the US has or Europe. Any positive thing to come out of that? Any impact from that in terms of how it may sort of be dictating its stimulus for its economy going forward, etc. And on that front, for example, it issued extra export product quotas last year just to to kind of stimulate the economy a little bit. Do you see it sort of playing with that tool, if you like, if to get things going?
I think they'll probably definitely play quite a lot on that side, simply because domestic demand, we're at that stage in China where anything they do with interest rates is going to have zero impact. They have to go big or go home. This is the whole point with China. Interest rates, China isn't that interest rate sensitive in any case. It's what it's sensitive to is its burden of debt. We were talking about the US burden of debt. The Chinese burden of debt is also enormous, particularly in terms of local government and the construction sector, and a lot of people allied to it. So a lot of fund management sector as well. The only positive in China at the moment really is that the savings rate is increasing. Therefore, if something is done, and I question whether it will be done, which really actually starts to improve confidence, because what we've got is demand being weak because there is no confidence. There's no confidence in industry and there's no confidence in the consumer side. But if something is done, then you could see quite a substantial amount of pent-up demand, and that would be a huge game changer. But it's what they do on the fiscal side rather than on the monetary side, which is going to be absolutely critical to China's outlook.
Okay, and there we go. We've got the result bullish. We'll switch from a year of monetary tightening to easing, actually be bullish for oil prices. 67% said yes. Maria, I'll go to you just for the last very quick comment. Again, on the debt sort of question and interest rates and costs of money. Emerging economies, dollar denominated debt that's being held with a lot of those much more vulnerable energy consumers, nevertheless. Again, what's the outlook for them going forward? Will the market be paying much attention to them making a difference, if you like, to the balances out there?
Absolutely right. So I think the big call for emerging market, the re-rating trade will depend on the dollar. If the Fed starts cutting interest rates in 2 or 3 increments, as Ola pointed out, we could see a massive dollar devaluation into the election, which will actually boost emerging market assets. So that is a sort of flip side trade, and the market's waiting for that. We've already seen some hints of them easing there, but that's not enough for them to get that economic growth that we need from the dollar. I think the key thing right in the next 3 months will be, will the Fed cut in March or will they cut in June? That determination is going to change the trajectory of the dollar and also emerging markets, and that's going to be very important. The market is very asymmetric in terms of expecting cuts, and it's very dovishly situated, but I think any sort of hawkish surprise could be a bit of tempered enthusiasm. We have inflation data coming tomorrow for December, then we have some more sort of data coming out. If the inflation is still quite strong, that the curve might get pushed out. So yes, it all depends on the dollar's expected path, and I think that will ease the pressure. Going back to the US debt, the interest payments on the US debt itself is probably close to 1.4 trillion. So the US government itself needs to lower rates to pay lower interest on its own debt. So yes, that's going to help them as well, which is another reason why they need to cut effectively at some point.
Okay, well, thank you very much, Meliha Bengali, Mark Ostwald, and Ole Hansen. We run out of time for the final session of our Europe panel. We're going to be going on to the Americas next, so please do join us and stay tuned. And thanks very much for joining us, everybody. All the best.
Thank you very much.
Bye.